Lucas, now Chief Market Strategist at InvestSMART. We just spoke to Josh Frydenberg. Evan asked about the tax cuts. He said they are currently making their way through the economy. Low GI, perhaps.
That's a very good way of explaining it, probably, in terms of how you look at it, Laura. Yes, it is low GI. Again, if you look at the flow through so far in terms of what's been in there, now give him some time, considering that realistically most people's tax actual credit would only have just come back in the last 6 weeks. So you can possibly give him a little bit of leeway, but you can see in things like consumer consumption, consumer sentiment, overall retail sales numbers in the last sort of 4 or 5 months since the tax cuts really came into it have not really moved through. They are that kind of level. I mean, $1,080 for a couple is a reasonable amount, but it's certainly not going to be the kind of level to really move the dial in terms of the overall pessimism that's currently sitting in parts of the economy that they're clearly trying to stimulate. And that's probably the way to look at it. And if you want to really fully evaluate it, it'll be this time next year when we start really asking the question, was it actually worth it? And have we actually seen any form of major changes? You're also asking the question around the timing of the next tranche and tranche 3 as well. That's the argument as well, is that realistically we have to wait till 2024 to actually see the full swathe of the new legislated taxation to come through. The question has always been around that time and whether or not it should be brought forward further and faster, considering that we have an RBA at the moment that is clearly stating very clearly that structural reform needs to come to the fore to also help with the monetary policy system that we're currently going through.
Evan, what about the other announcement from the Treasurer today, those tax incentives for the big companies to fast-track big projects? Do you think that could have a positive impact?
Partly, yes. I mean, the argument around all of that at the moment is that it's not just on the fiscal side. If you look in markets as a whole, funding has never been cheaper in terms of how you do it. The ability to actually borrow money globally is incredibly low in terms of where we sit. So, yes, it will be another step towards that idea, but the regulation is probably part of that, actually looking at forms of structural changes with regards to employment and how we go along that. Also fast-tracking, infrastructure regulation is another part of it. Getting through planning approval, getting through building approval in a much, much faster reactionary way would be probably also a way that maybe the political side could move on that. And that's, a part of it. He alluded to our AAA credit rating, and that's the other thing of this with regards to your question around funding, Pete, is funding at the moment could be done very, very quickly with things like infrastructure bonds. They are clearly being very much looked at in Europe and the US. Big pension funds in both countries and also here in Australia are screaming out for things like infrastructure bonds, considering that they would pay above normal sort of coupon, but also with the security of a AAA credit rating of the sovereign would make them a very, very attractive investment indeed. So funding could happen immediately. Again, putting all of that question together along with what Laura just asked is they could happen much, much faster if, again, it's the regulation side that realistically needs to change and allowing a bit more speed and a bit more proactiveness to actually happen through the economy quicker.